Hello, everyone. In 2025, Donald Trump returns with a bold new tariff plan. As tensions grow and uncertainty rises, we ask a key question. Can the US use debt and the dollar to rewrite global trade rules? In this video, we'll explore the logic behind Trump's strategy, the role of the dollar, and its global impact. Welcome to Trump's 2025 tariff gamble, debt, dollar, and the future of the global trade.
The rise of the US dollar as the world's primary reserve currency is a story deeply connected to the Bretton Woods Agreement signed in 1944. This historic agreement established the US dollar as the anchor of the global financial system, reflecting America's dominant economic position after World War II. The USD quickly became the preferred currency for international trade and investment, overtaking the British pound. Currently, the US dollar continues to dominate global finance, representing around 60% of the world's foreign exchange reserve. It is involved in over 80% of all international trade transactions, reflecting its unparalleled influence in the global economy. Despite its dominance, the US dollar faces growing challenges. Emerging economies, particularly China, are effectively promoting the use of alternative currencies such as the Chinese yuan to reduce their dependency on the dollar. Meanwhile, the rise of digital currencies and shifting geopolitical alliances add further pressure, potentially reshaping the future of global finance. The 90-day reciprocal tariff policy introduced by the Trump administration aimed to correct what were viewed as unfair trade imbalances. By imposing tariffs on a broad range of Chinese imports, the US sought to protect domestic industries and push China towards more balanced trade practices. This marked a significant shift from traditional free trade policies to a more protectionist stance.
For this part, I'd like to talk about global market risks in dollar system. After the 90-day tariff pause, market briefly rebounded, but structural problems remain. At the core is US dollar unique role as the global reserve currency. Since the collapse of the Bretton Woods system, the dollar has been detached from gold. This gave US seigniorage power and allowed it to borrow freely from the world. Over time, the US developed twin deficit problems, both the physical and current account deficits, and shift the burden of its internal risks to the global system. Let's move to the Trump's first major strategy. On the surface, tariffs look like the protectionism, but in fact, they were aimed to boosting the revenue and reshaping the domestic industrial. By raising the import costs, Trump tried to push manufacturing back to the USA, increase the local job, and rebuild the tax base. This was also a move to break American dependence on the global supply chains, such as Nixon once used a gold on the coupling to escape the limitation. Trump used the tariff to rebalance the physical structure and response to the industrial hurling. Next, we see his second major logic, pushing back against international institutions. After Bretton Woods, the IMF, World Bank, and WTO shape the global order. While they promote the globalization, Trump believed that they limited the USA. The USA has paid a high price: credit risks, open markets, and global stability. Trump rejected these burdens. By using this tariff, he bypassed the existing rules to regain the negotiation power. This was not just economic, it was a struggle challenge to the global system, seeking to shift the burden from the American to other countries. To conclude, Trump's tariff policy was not just about the trade. They reflected deeper concerns. They aimed to fix the structural deficit to the dollar system by limiting the imports, weakening the global institution, and restoring the capital. The USA tried to reclaim the physical space and global leadership, but there are serious side effects. Supply chains are shifting, especially away from China. The dollar credibility may weaken, and we may see the faster rise of the multipolar currency system led by the euro, the yuan, or another. Now we've outlined the logic behind the Trump's tariff strategy, linking the physical stress, industrial policy, and global institution. I'd like to invite Wei Jia to take us further.
Now let's look at how Nixon and Trump justified major disruptions to global economic rules, not just in theory, but through action. In 1971, Nixon suspended the dollar's convertibility into gold, collapsing the Bretton Woods system. But this was only one part of his broader new economic policy. He froze wages and prices, imposed a 10% import surcharge, and pressured trade partners to revalue their currencies. These emergency moves aimed to restore control and combat inflation. Crucially, they laid the foundation for a fiat dollar system, backed by trust, not bullion. Trump faced a very different crisis: industrial decline and frustration with global trade rules. Rather than reform currency, he turned to tariffs, freezing multilateral institutions and launching a national strategy that framed trade as a matter of sovereignty. He relied on global dependence on the US dollar to pursue these policies with minimal resistance. What enabled both presidents to act unilaterally was the dollar's special status. Nixon's reforms unlocked full seigniorage, allowing the US to print while others held. Trump leaned on that legacy. As long as the world needs dollars for trade and reserves, the US has leverage. But overuse risks eroding that trust and accelerating moves toward alternatives. Let's compare the two. Nixon built the fiat system we rely on today. Trump tested its limits. More importantly, their contexts differed. Nixon acted during the Cold War with few alternatives. Trump operates in a multipolar world, with rising rivals and diminishing US authority. So while both presidents tried to rewrite the rules, only Nixon's disruption created a new consensus. Trump's may have revealed just how fragile that consensus has become.
Next, I'll be presenting the short-term impacts of Trump's 2025 tariff policy on different countries. Let's start with the United States, where the results were quite mixed. On the negative side, GDP growth in Q1 2025 dropped by 0.3%. And the Consumer Confidence Index fell to 86, indicating a decline in consumer sentiment and spending. Additionally, import volumes from China dropped by as much as 40%, causing serious disruptions to supply chains. However, there were also some positive effects. The tariff policy led to a reduction in the trade deficit, and demand shifted more toward American-made products. Most notably, tariff revenue nearly doubled from $9.6 billion in March to $17.4 billion in April. This raises the question, can this increase in tariff revenue help reduce national debt? Unfortunately, not really. The $17.4 billion in tariff revenue accounts for only 0.05% of the US federal debt, which stands at $36 trillion. Moreover, $9.2 trillion in debt is maturing just this year, so this revenue alone is far from sufficient to make a real difference. Now, let's look at the impact on China, which was the main target of the 125% tariff. In April, China's exports to the US dropped by 21%, and its manufacturing index, PMI, fell below 50, signaling contraction. Millions of export-related jobs were at risk and in retaliation. China imposed export restrictions on rare earth elements, putting pressure on the US tech and defense sectors. That said, China also responded strategically by diversifying its export markets and restructuring supply chains towards Southeast Asia and Europe. On the other hand, US allies such as South Korea, Japan, the EU, and Australia were given a 90-day tariff suspension. This allowed them to avoid immediate damage. Some countries were even able to fill the gap left by Chinese exporters, increasing shipments to the US. For instance, Korean semiconductors and Vietnamese electronics saw notable gains, and supply chains began shifting more actively into Asian regions.
Trump's 2025 protectionist policies have reignited global debate. His tariff-driven strategy aims to revive the U.S. economy, but there are many questions whether it will echo Nixon's success or instead spark a deeper market crash, economic crisis, and challenge the dollar's global dominance. Nixon tackled economic turmoil in 1971 by delinking the dollar from gold and imposing temporary tariffs, while Trump's 2025 move to impose tariffs up to 145% has already caused a GDP decline, shaken consumer confidence, and dampened business investment. As Wei Jia noted in the previous part, current indicators suggest he may not be able to repeat Nixon's success. While Trump's high tariff policies, for example, tariffs on imports, have caused supply chain disruptions, higher business costs, and financial market turmoil, The current global economy is more resilient and robust than during the 1930s Great Depression, so causing a similar collapse is unlikely. Persisting protectionism, as warned by the IMF, however, could slow global growth and raise recession risks, with the US potentially facing the hardest impact. Trump's tariff policy is already rippling across the global economy. Export flows from countries like China, Germany, and Japan have been restricted, while rising tariffs on imported parts have disrupted supply chains and raised firms' operating costs. Meanwhile, market uncertainty and shaken investor confidence are dampening global growth prospects. If the US stays on this protectionist path, it risks tipping the world into a broader recession. In the short term, the dollar remains dominant thanks to the strong inertial forces, its reserve share, global clearing network, and US military and institutional strength. Despite from the video, some viewing China's currency as a potential alternative, China is reluctant to fully internationalize the yuan. Therefore, the dollar's global role is secure for now. However, Trump's protectionist policies and skepticism toward international institutions may erode global trust, risking the dollar's long-term dominance.
In conclusion, the US dollar has maintained its dominance as the world's primary reserve currency since the Bretton Woods era, supported by economic strength and financial stability. However, policies like Trump's 90-day tariff have highlighted the challenges it faces. These tariffs created short-term trade disruptions and economic uncertainty, potentially weakening the dollar's global influence in the long run. As we look ahead, the dollar's future will depend on how it navigates emerging economic forces, technological changes, and shifting geopolitical landscapes. Thank you.